65% of Americans believe they are above average in intelligence. Results of 2 national representative surveys. Illusory superiority, where you overestimate your own positive qualities. So when it comes to being smart, the market is smarter than you are, and you have to listen to it. Now, as we all know that there's all these get-rich-quick schemes out there, you know, the SpaceX IPO, everybody wants to get rich quick, gets in line for it. It's just something we have to be aware of. Now, again, I want to emphasize that Jesse Livermore said, first, do not be invested in the market all the time. There are many times when I have been completely in cash, especially when I was aware of the direction of the market and waiting for a confirmation of the next move. Second, it is the change and major trend that hurts most speculators. So what we want to look for is something called a follow-through day. We want to see if the market can follow through to the upside, and so far that's just not happening. Gerald Loeb wrote a book called Battle for Investment Survival, and he said, and you might want to pause your video player to read this, but basically what he's saying is that the principal virtues of Wall Street are its continuous quotations and the comparative satisfactory liquidity of selected securities. There are some rules that hold, and my first is to buy only something that is quoted daily. The reason I bring this up is we're seeing a lot of activity in private equity. And I will say this about venture capital, which is very similar to private equity. 90 to 95% of the deals don't make it. Now, something I'm a little concerned about is something called the rise in passive investing. Now, it's been very obvious that being invested in the indexes have been probably a good way to go. However, there's a price to pay for this. And if you, again, pause your video player and look at this, but basically what is happening here is that whether a company has earnings or the balance sheet is good or whatever the fundamental reason is for owning the stock, passive investing has caused a real difficult situation here. Back in the early 1990s, only 2% of the volume was in passive investing. It's now approaching 60%. So recently highly publicized research from his group was Dimitri Vayanos with the London School of Economics is talking about the explosive growth of passive investing, and it disproportionately inflates the price of mega firms and disrupts the efficiency price discovery. So in other words, you're getting a lot of difficult pricing because a stock will go up just because it's in an index, not because it's doing well or the balance sheet looks good or so forth. It's called artificial pricing. We're seeing a tremendous amount of demand in the passive stocks, the index stocks, and as a result, we're getting artificial pricing. So a company can be extremely overvalued simply because the indexes are buying it. So it's just something to be aware of. Now, take for example IBM. Now, this has to do with people being smarter than the average person. But you can see with IBM, I've always said you want a proper base. Like here was a proper base building, but it broke down, another base, and then it rallied. But it dropped 25% in one day and over 60 million shares. So that tells you that there's a lot of investors out there that feel that IBM has a problem. So to try to be smarter than that is somewhat ridiculous, but we'll see. Now, has the bubble popped? Are we in an internet bubble? Well, if you take Applied Materials from the high to the low, it's down 30.61%. Then if you take Advanced Micro Devices from the high to the low, it's down 21.29. If you take ARM Holdings, which is another semiconductor company, From high to low, it's down 46.29%. If you take Intel, and let me get my numbers here. Intel is down 37.09. Then if you take Micron Technology, from high to low, it's down 35.93. So basically, we're in a situation here where it looks like the leadership is changing. So if you notice here with the NASDAQ, we've got the high, the lower high, now we have a lower high, but we're not making lower lows yet. But it is holding in this general range. But the NASDAQ is the poorest performing of the indexes that we're going to look at. The mid caps actually holding up pretty darn well. I believe that's what I'm seeing here when we review all of the stocks that we look at. We're finding that the AI stocks do appear. I'm talking about like the companies that build the large data centers, the hyperscalers, are having the biggest problem. But there seems to be a migration into companies that benefit from AI, and we're actually seeing that to some extent. Then if you look at the New York Stock Exchange, which is a lot of the larger, more defensive stocks, it's holding up pretty much the best. So that's financials, automotive, railroads, transportation, so forth. Then we have the small caps, which are holding up well as well. So it's the NASDAQ that's really having the most problems here. Then if we look at the S&P 500, it's holding up pretty well too. The defensive stocks are pretty much holding up the market right now, whereas the more aggressive growth stocks are having difficulties. So if you have any questions, please let me know. Thank you very much.